Welcome to the Daily Block. Here are the top 8 things that shook crypto markets today, and why your portfolio will either thank you or flame you into the void. SEC Chair promises an innovation exemption for crypto firms by year-end. SEC Chair Paul Atkins says an innovation exemption, basically a principles-based fast lane with guardrails, is coming before the end of 2025, and he's promising tighter coordination with the CFT. The idea is to create generic market structure standards and ETF rules so novel crypto products don't need bespoke approvals every time someone invents a new token wrapper. Translation: regulators want less red tape theater for repeatable product types. Why it matters for trading and positioning: a credible, faster regulatory path lowers listing friction and can turbocharge institutional launches, new tickers, and liquidity. Risk or counterpoint: promises are cheap, timelines slip, and the exemption's guardrails could still be tight enough to choke some product designs. Don't treat a press quote like guaranteed flows. Next one. UK and US form a task force to harmonize Bitcoin and crypto listings, custody, and disclosures in 180 days. Finance teams in London and Washington launched a 6-month sprint to align cross-listing rules, custody and sub-custody standards, model disclosure annexes, so US-cleared products can be ported fast to London. The aim is to shave weeks off the secondary listing timeline by standardizing custody sub-delegation FAQs and disclosure templates, basically make the same ETF ETP playbook work in both venues. Expect lobbyists and lawyers to get busy, while traders grin at the idea of more venues for arbitrage. Why it matters for trading and positioning: easier dual venue listings mean wider market depth, thinner spreads, and faster ETF rollouts, more liquidity and arbitrage windows. Risk or counterpoint: harmonization helps but doesn't erase regional politics. Firms still need to clear local rulebooks, and some custodial questions will remain hedgeable but unresolved. Zero Hash raises $104 million and hits a $1 billion valuation, led by Interactive Brokers, with Morgan Stanley, Apollo, and others joining. Zero Hash extended its Series D, selling institutional rails for stablecoins, custody, and tokenization, and the round pulled in strategic clients as investors like Interactive Brokers and Morgan Stanley. The pitch is turnkey plumbing, so banks and fintechs can move fiat, mint stablecoins, and custody tokens without building everything in-house. More serious plumbing being owned by big incumbents is not sexy, but it's where institutional scales get built. Why it matters for trading and positioning: better on-ramps and custody lower barriers for big allocators, which means structurally more liquidity and eventual flow into tradable products. Risk counterpoint: centralized plumbing can concentrate risk. A few failed integrations or compliance hits could slow adoption, and private valuations don't equal product uptake overnight. Ethereum ETFs and treasuries see record inflows and a shift to productive treasuries. Spot Ethereum ETFs pulled in $534 million in a single day and accounted for roughly 15% of spot volume, while corporates are increasingly staking ETH or using liquid staking wrappers to earn yield and keep liquidity. Reports suggest about 10% of circulating ETH has moved into institutional hands, with firms placing assets into staked wrappers that yield roughly 3 to 5% while remaining tradable. That's not just HODL anymore. ETH is being used as yield-bearing corporate capital. Why it matters for trading and positioning: ETF flows plus staked institutional treasuries create stickier demand for ETH versus Bitcoin's idle reserve model, changing sell behavior and correlation dynamics for alts. Risk counterpoint: liquid staking adds counterparty and composability risk. If a wrapper depegs or unstaking becomes chaotic, sell pressure could come fast and ugly. Aster on BNB chain explodes, 20 to 25 billion in daily perp volume, dethroning hyperliquid, validators proposing steep gas cuts. Aster's token launch and features like hidden orders and MEV-free execution sparked massive perp activity. Daily volumes and open interest spiked into the billions and briefly outpaced hyperliquid. BNB chain validators are pitching gas, down to 0.05 GWay and faster block times to lure liquidity, while whispers of concentrated token supply and whale rotation from HyPA to Aster swirl in the forums. It's a liquidity circus, sick volumes, but with very visible strings. Why it matters for trading and positioning: ultra-low fees and deep perps create new venues for big directional and market-making flows, high opportunity for intraday scalps and gamma trading. Risk counterpoint: concentrated supply, insider allocation, and whale flows amplify tail risk. On a bad dump or rug, liquidity can vanish faster than your stop orders. Bitcoin market action around 112 to 113,000, mass liquidations, and noisy ETF flows. Bitcoin traded near 112 to 113,000 after a liquidation cascade. Tracking showed more than 128,000 traders liquidated and roughly $284 million wiped out in 24 hours. ETH creation and redemption flows are bouncy, and net flows have been noisy, leaving short-term directional pressure despite macro narratives like Fed easing that remain supportive. Support bands around roughly 111 to 114,000 are in focus for anyone trying to pick a spot. Why it matters for trading and positioning. Leverage is where money is made and destroyed. Monitoring funding, open interest, and ETF flows is critical for timing entries and exits. Risk counterpoint. Liquidation clusters can flip support into resistance. Playing intraday with leverage without iron discipline is a guaranteed way to feed the exchange. Tether mulling a massive 15 to 20 billion raise at an implied 500 billion valuation. USAT in the spotlight. Tether's Paulo Arduino says the company is exploring a private placement of 15 to 20 billion from select institutional partners to scale stablecoin distribution, AI work, commodity projects, and a US-compliant stablecoin called USAT. If Tether actually raises that much capital at valuation, chatter around 500 billion, it would turbocharge their product roadmap and distribution reach beyond current USDT dominance. The stablecoin wars just got louder if this moves from chatter to closed deal. Why it matters for trading and positioning. More capital behind Tether could expand USDT rails, increase liquidity, and reshape stablecoin market share, big for flow and funding rates. Risk counterpoint. Regulatory scrutiny and political pushback in the US could blunt expansion plans. A large capital raise doesn't immunize the company from compliance risks or market optics. Bitwise CIO Matt Hougan stays bullish, predicts corporate Bitcoin holders will double, and ETFs will accelerate into cure. Bitwise's Matt Hougan is calling dips buying opportunities, forecasting corporate Bitcoin holders roughly doubling in the coming year, and ETF flows accelerating into the fourth quarter. He thinks digital asset treasuries will keep adding exposure and views pullbacks as tactical sweet spots for accumulation. It's the institutional optimism narrative you hear at conferences and on thesis decks. Why it matters for trading and positioning. If corporates and ETFs really step up, it supports higher floors and gives traders a reason to favor accumulation on dips rather than pure momentum chasing. Risk counterpoint. Positive narratives can get priced in quickly. If flows disappoint, sentiment-driven reversals can be brutal for anyone levered long. All right, quick takeaways you can scream in the group chat. Regulators flirting with faster paths equals more tradable product and liquidity. Plumbing investments from incumbents reduce institutional friction. The ETH is turning productive, and that changes playbooks. New exchange and chain venues are hunting perp volume with low fees. Great for scalps, dangerous for position traders without risk controls. If you like the chaos and want this every trading day, hit subscribe and save yourself the scrolling. That's today in crypto, where the gains are imaginary and the pain is real.